WTF, I think really sums up the absolute absurdity that this president is putting the market through, with levels of trading in the trillions of dollars unlike anything in history, at least in my 10 years of investing. And man, oh man, there's going to be some massive learning lessons that come out of this for so many of you that some of you have been arguing with in the comment section below. I'm going to iterate some of that in this video because, like, you could not have predicted this, except for Trump gave you the insider news here that the market was going to absolutely pump. I think within the last 5 minutes of me literally making this video on the market pumping, the wife and I, our accounts jumped up over $30,000. I mean, look at the gains here. The S&P 7.7% literally within like a few minutes. SCHD, XEQT, all my stocks. Google's up 7%. Meta's up 11%. I mean, look at the pumps just across the bloody board here. Wow. Hood's up 20%. Bitcoin, like I'm just telling you guys, I feel bad because so many people start thinking they know what's happening tomorrow and they see the endless selling going on, and they don't realize that when you miss these few days where the market pumps insanely like this is where most of the returns actually get made, and missing these few days really hinder that total compounded growth over long periods of time. It's why I don't try and judge where the tops or bottoms are. I just buy like a nut job when things get a little too crazy to the downside. Now, that's not saying that we're not going to continue to go down at some point. This is just an initial bump. I fire any financial advisor that tells you what's going to happen tomorrow. But in this video specifically, I want to talk about removing some of the volatility from your portfolio, because I've been very grateful and thankful to actually talk with you guys one-on-one, and actually a lot of you during this market volatility, because you booked a one-on-one at kylelivingston.com, link in the description below. And a lot of you see the transparency I offer and have given me some respect to have conversations, not as financial advice, just through my own opinions and experience of being through the market for a decade. And it's crazy to even look at my portfolio down at $1,600, and tomorrow when this adjusts, I can't even imagine what it's going to be up at this point. But I noticed that so many of us YouTubers talk about what works for us, things that we like, that really kind of cross-pollinates between all YouTubers, but that might not be what works for you. And these one-on-ones, I really focus on talking about what's maybe more adjusted for somebody that's in their 60s, that's retiring, or somebody that's in their 20s, or somebody that doesn't have the same risk tolerant levels. And I notice, again, us finfluencer clowns out there, and I have a deep deal of respect for Beavis Wealth, but you know, anytime these market volatility periods hit and they're like, what are you buying? What are you buying? And it's always the same rhetoric. Oh, VOO or VFV and SCHD and option ETFs and, you know, all the same stuff you hear about over and over and over again. But I really want to talk about two ETFs just to mix things up, to give you an educational piece, because a lot of you seem to like when I give some anecdotes to things that help you think clearer when you're looking at investments that work for you. And I want to talk about the dividend side and the volatility side, because a lot of people want income, and I want to talk about some of the fallacies and pits that people put themselves in, how to avoid them, because I personally pair in my portfolio two ETFs on the Canadian and US side of the border. One is SCHD and one is VDY. You're probably well aware of them. And a lot of people ask me, like, why do I buy, for example, VDY in the Canadian side of the market over ETFs like XEI or XDIV that offer a higher yield, paid monthly, a little less volatile perhaps than VDY? And I'm here to tell you that I don't care about the dividend as much as I care about the stability, not necessarily the stability, but the total return stability, right? Like, what's the long-term track record of these ETFs? Because if a track record hasn't been around for at least 10 years, it's really hard to judge what the returns are going to look like in the future through periods in the market like the pandemic, the 2022 market cycle, some other cycles with oil. It really helps give you a clerical long-term view, right? So with VDY as an example, what I always recommend is going into the fact sheet, because you can scroll through here. Like, obviously low expense ratios are great. 0.22% is awesome, but I wouldn't recommend just throwing all your money in something like VDY, because like if you're in retirement, for somebody that's looking for those kind of investments, this is a highly concentrated ETF with 15% just in Royal Bank. That isn't something you might want in your retirement. So you might look at something like XEI or XDIV that has more diversity. But again, with that diversity comes lower performance, because VDY over its entire history, if you go into the fact sheet, since inception has offered a 10% annualized return. The lowest return over any period was the last 3 years at 7.5%. But I mean, some years as high as 20 or 22%, which is astounding, right? So you really have to take into consideration what your goals are, but you shouldn't get shrouded by just dividends, because then you're going to go into option ETFs that yield 14%, let's say. But those people that look at that and say, oh my God, a 14% yield, that's great for my retirement. And they don't look at the total stock returns, because that is the reality of what you're buying. It's not just the dividend, it's the totality of return. And when it comes to option ETFs, I want to show you a great US dividend ETF that you compare with a Canadian dividend ETF like I've done with SCHD and VDY, but might work for somebody better in retirement. Not as financial advice, just something so many of you have asked me about and I've never commented on directly because I don't like most option ETFs, and the ones I do like, you might not like because the yield's not that high, but you have to consider the total return. I really like DEVO, the Amplify CWP Enhanced Dividend Income ETF. This one, during this market volatility from peak to trough here, has dropped about 12%, so maybe a little bit more than half of what the S&P has dropped, but it has a long-term track record. It looks fairly stable overall, and if we look at the underlying fundamentals here and the total returns, you're going to be wildly impressed. Now, with option ETFs, you are going to pay a higher expense ratio, of course, 0.56%, but honestly, across the board for option ETFs, that is a fabulous expense ratio from what I currently see, with a distribution of 4.85% and paid monthly. This could be something better paired in our registered retirement savings plan. If you put it in a TFSA, you do have to be aware there's a 15% over the border withholding tax on the dividends paid. If it's an RSP, those dividends are waived. This is something I've even considered buying in my register retirement savings plan to continue diversifying over time, but maybe something in the future that I'll consider. But if you scroll down and just take a look, I want you to just comparably look at the total returns. Firstly, the fund holdings are great. American Express, no one stock makes up more than 5%. You got JP Morgan, Visa, Caterpillar, Microsoft. I think even Meta's in here, Honeywell International, really diversified, really great exposure. And if we just take a look, since inception, this ETF has offered an annualized return of 11.78%, with the lowest being 7.97 over a 3-year period. These annualized returns are muy bien. And with a 4.8% yield, keep in mind you're losing about 0.5 of that to that expense ratio. So the yield's probably closer to what, 4.3, 4.4-ish. That's a great yield paid monthly, right? After the expense ratio is paid in a year. So I would pair an ETF like this if I was in retirement with an ETF like ZLB. This is the BMO Low Volatility Canadian Equity ETF, and I mention it a lot. And the reason I mention it a lot is because look at this chart. You have more than a decade of performance, incredible stability with the exception of the pandemic, which was a very rare experience in the market. And even during this current market cycle crash, this ETF has only been down 6.53%. If we take a look though, however, a lot of people will be turned off because the dividend is only 2.39%, expense ratio right around 0.4, which isn't bad. So after the expense ratio, you're getting right evenly at about a 2% yield. So if you were to pair this with DEVO, let's say, you're going to be getting about a 3.5, I would say 3.5% dividend yield, give or take. That's pretty damn good. A 3.5 is almost in line with what SCHD is paying. But again, if we take a look at the holdings and annualized returns, we'll start with the holdings here first and foremost, if I can find them. The holdings are incredible because this focuses on stocks that have less deviations during market fluctuations, right? So you're getting things like Metro, Empire, Loblaws, food companies, Waste Connections, a company I love, Hydro One, Fortis. Incredible companies, right? And if we go back to that fund performance here and we scroll down, you can see that the since inception annualized return is 12.12%, with the worst being over the last 3 years at 8.77. These are astounding returns that match and sometimes even beat the S&P 500. This is why I love ETFs like this, because they're fun to kind of scavenge through and find depending on what your needs are within the market cycle. And I've been talking to a lot of people in retirement that cannot handle these absolutely absurd ups and downs. They do not like the gyrations. So I said, look, if you're willing to sacrifice a 7 or 8% yield and you focus on total returns and just realize that a 3 to 4% yield is very healthy, it will grow over time and your equity will increase as well over long periods of time. You get the best of both worlds. You can actually do far better than you would even do with the dividend, and it never hurts in periods of explosive market environments like we had up till this recent year. You can take profits, right? Like that's what I told my mom, and she takes profits. She bought a car in her retirement because it's not that big of a deal to balance growth and income. And I think a 3 to 5% yield can be easily achievable with the ETFs that are out there, especially if you pair these with, say, XEI. Like you could take XEI, ZLB, and Devo and get such incredible broad diversification between the US and Canadian markets, remove a lot of this volatility, and still get an exceptional yield. Because what's XEI paying right now? You know, a lot of people point to this in retirement. Let's see what the deviation is from peak to trough here. I mean, during this market crash, you've only really experienced a 9.8% drop. Not that bad at all, right? And let's just take a look at this one, for example, that has probably a much lower expense ratio that I think is at 0.2%. The holding's very diversified, no more than 5%, with Royal Bank making up some of the largest. And if we find the dividend yield here, it's currently 5.24%. So if you look at these kind of ETFs and you find a way to balance them correctly with your own risk tolerance, your own sector allocation you like, I mean, these three ETFs paired together could easily yield you closer to a 4% equally weighted, give you the best diversification, low volatility. Wow, and an exceptional total return. I wonder what the total returns. Can I see that in here with the performance? Will they give me the, yeah, I mean, since inception, however, see, this is, again, why I look at total returns. This has only been 7.33%. So with the dividends in totality, this one hasn't been the greatest, right? But that doesn't mean you can't pair it with the other ones, increase your yield a little bit, and still overall encapsulate a great total return. These are all things that I just want you to take into consideration when you're looking at ETFs, regardless of dividends growth. All that stuff is kind of noise in the sense of what has it actually annualized in combination of all of that. Because even if we go back to SCHD as an example here, and let's just take a look at its annualized returns, because a lot of people are like, oh, yield on cost and, you know, the total returns and all that. When you take a look at this, since inception, it's been 12.94%. That is incredible, right? But that doesn't really equate to, like, a lot of people look at dividend growth and all this stuff, but that doesn't really actually matter, because you still need to get a total encapsulated return. Just because the dividend's going up, if the ETF's not growing, with the dividend return, your total return could still be absolute trash. So I'm hoping that with these educational pieces, you can kind of take some tidbitted advice and figure out what's going to work best for you. Because the only thing that I can state over and over and over again is, I'm going to beat it like a drum. You don't know what happens tomorrow. If your financial advisor tells you what's going to happen, fire them. The only thing you can do is figure out what allocation set of stocks, bonds, treasuries, whatever makes you most comfortable. Maybe pick 3 to 5 baskets of ETFs and just non-stop every other week, every month, keep buying them, regardless of the ups, regardless of the downs. Now, you could be like a squirrel without a nut like me, who just goes bananas when the market crashes, because I recognize, and I'm going to say this again and try and say it with some velocity here. Look at VOO again. Where did you make the most return? If you bought the peak of the pandemic, you would have only seen a 60% return from top to bottom in the last 5 years. Ooh, I feel bad for you. You bought the top of the crash. Ooh, heaven forbid. But if you were an absolute moron, you still did well. But if you actually kind of fought against the grain and said, this is a once in a lifetime event, these don't happen very often, the market tanked by 30, 40%, maybe I should be buying all the way down, like I've been doing, like I've been trying to exemplify to you with my stock market emergency fund. And now you'd be up 115% from the bottom with anything you were able to nibble and actually achieve the bottom buys. That's why since the beginning of April, it's not even been 2 weeks, and I put like almost 20 grand in the market. Now, obviously, if we take a look at what that last month has looked like, it would have been much better to, you know, because I've been buying like all the way down here and a lot around here. Obviously, we're not back to those returns yet, but I have been buying down here too, haven't I? Eventually, this will come back over the next 5 or 10 years. Am I worried about it? No. That's why I'm sitting here laughing at the emotional stress all of you put yourselves through for no reason. Just keep buying. If you're not retiring tomorrow, and if you are retiring tomorrow, consider your asset allocation and what best suits your risk tolerance, because you shouldn't be stressing out in periods like this. If you are not invested correctly. But on that note, I'll pass the question off to you. I'd love to know what you think in that comment section.